So, welcome to LeAnn Riley's Real Estate Investing Club. And I think I'll take the slide down. You got to bear with me. I'm new at this technology. There you go. Now you get to see me and Evan, our guest, and I'll introduce him in a moment. So, I'm LeAnn Riley, and I help busy people build wealth and income through real estate investing without being stuck in confusion or fear by mastering the art of real estate investing made simple. And this education is foundational for those getting started as real estate investors or for experienced investors. And we're broadcasting live right now on the second Wednesday of every month at 7, and I have great guest speakers. And you can learn from the experts, and that's what we're going to do today. Here's the great thing. You can participate from anywhere, and you can be in your jammies, and we all love that. We don't have to go out in the cold, and you can get your questions answered right on the spot. That's what's cool, too. So over there in the chat box on the right, and I see a few people have logged in and said who they are. That's great. Tell us who you are. Glad to see you. And that's how you're going to ask your questions when we dig into asking Evan what he's up to. Okay, and I'm a real estate expert who leads a team of investment property realtors called the Encore Investment Team right here in the Twin Cities of Minnesota. And I can see I've got some people on here that are from a lot of different cities. And why me? You know, why can I lead this webinar? Because I built a multi-million-dollar portfolio of properties, including residential, multifamily, condo development, commercial, and vacation properties across several states. And I'm a national coach and a trainer. I teach my proven profit formula to people around the whole US, and I help people get started as investors, help you choose a strategy and a location and how to acquire properties. And today we're here with the Investing Club, and it's a free monthly virtual live webinar. So thanks for coming tonight. And again, the chat box is over there. That's where you're going to ask your questions, okay? And so I'm going to try to answer all the questions, but hold off because Evan will give us the answer and then we'll try to get to everybody, okay? So first, we want to get acquainted and see who do I have as the guest speaker today. And before we get started, though, I want to take a little poll here of who's on the webinar, and this helps us to decide who we talking to, so we can really gear our talk. So over in the chat box, can you see it? I put a poll up, and all you have to do is check the box that you fit into of which strategy are you using in real estate investing. Can you see it, Evan?
Let's see here.
The poll.
Poll page, yeah, I can.
Good. So people just go ahead and answer the poll. Pick your box. Yep, I see people answering. Good. And we just kind of want to see who's listening so we can really talk to you, because we're pretty smart about real estate investing. So let's address that. Okay. Over there in the poll. Now I'm going to end the poll. Oops, some more people are answering. And that's you can all see the answer here, and that will help you see who's on this webinar. Whoop, it keeps switching, doesn't it? There's a lot of people coming on right now. All right, I'm going to end the poll. And now can you guys see the answer?
I can, yeah.
Oh, good. So we got some fix and flippers here, a little bit of wholesalers. Somebody's trying the BRRRR strategy, and maybe one turnkey person. A lot of buy and hold. That's my favorite. Buy and hold. That's where you get that cash flow. And there's some house hackers on here. So that's really great to see what are people up to.
I don't see the answer.
You don't see the answers. Interesting. But you can, Evan.
I can. Yep.
Yeah, that's interesting because
Maybe it's just the delay.
maybe it's a delay. Yeah, there's always a delay.
Yeah.
Did it come up? Interesting. All right. So I did the poll, and now I'm going to move over to our guest. So today we have Evan Uribe. Did I say it right?
Perfect.
Okay, good. And he has grown a portfolio really quickly through buying and adding value with multifamily properties, along with living for free. So I want to know how he did it, and I bet you do too. So first I want to tell you, how did I meet him? Well, actually, an agent on my real estate team introduced us. And I was really impressed right away by Evan's tenacity and how quickly he built a robust portfolio. So he already spoke live one time to our group, but I want to know more. So here we are today. And I'm going to start by asking him a few questions that'll get you acquainted with him. So first, how did you get started in real estate, and what did you do before real estate?
Yeah. Well, firstly, thanks so much for giving me the opportunity to speak again, LeAnn. I really appreciate it. Yeah, how did I get started? So back in late 2014, 2015, my then girlfriend and I got engaged, and we have both always been very financially minded. So we always lived very frugally and saved a lot of our money, didn't go out and spend lots of money. We decided to buy a house because that's always what people do. It's just the order of operations is one of those things you do is you buy a house. But that wasn't quite right for us. So while we were looking around, we kind of hit some of the general areas, bigger pockets, rich dad, poor dad, all the kind of usual suspects as, someone who's first looking into how do I become financially free. And we actually decided to buy a triplex and owner occupy it. So that was our very first place that we lived in. So we purchased a triplex in South Minneapolis, where we live, and we bought it with an FHA loan and owner occupied the 2-bedroom unit on the upper level, and then there's 2 1-bedrooms below. And the big thing that did for us is it kind of reduced our structural costs. We may not have been living in our perfect, if people are here from Minneapolis, Edina is kind of like the really nice, fancy neighborhood. We were living in like the typical single family home lifestyle, but we were living for free at the time. Again, our tenants paid for our mortgage, and that enabled us to save probably about $18,000 a year. And that's a significant amount of money.
Yes, it is. That is. But what were you, and so you bought that first one, but were you both working W-2 jobs?
Yeah, sorry. Yeah, you did ask that. So my wife is still a school teacher. She's a 5th grade literature teacher. And I am was a wedding photographer. I still do some photography, but it has phased out. I used to be doing about 25 weddings a year. Nowadays, I'm doing about 4 or 5 weddings a year.
So you had that W-2 income, which helped you qualify for that triplex with the low down payment.
Yep.
Yeah.
And then I had also been doing this wedding photography business since I was in college. My freshman year, I got a grant to start my own business. So I had the requisite 2-year minimum kind of tax history necessary to kind of give the underwriters what they needed to help qualify us.
Yeah, what Evan's talking about here is when you're self-employed, it's a little trickier to get that mortgage. They want 2 years tax returns, and they want to dissect your business, right?
Oh, yeah, definitely do. They want to make sure that you're actually making money.
That's right. So it really helps if your partner or spouse has a normal W-2 job. That certainly helps offset it. If you have 2 self-employed people, it can get a little trickier, but it's just paperwork, really. Give the mortgage people what they want. And I would say they're fairly lenient with self-employed people. They understand that we write off everything.
Mm-hmm. Yeah, you just need to find a bank or a broker who understands what it means to work with someone who's self-employed, and they're out there in every state.
Okay, and now I'm going to put up a slide just so the people get really clear what we're talking about with house hacking and BRRRR. So I just put this together. A house hacker is someone who buys multifamily. That's what Evan did. And they get an owner-occupant mortgage. So therefore, it's a lower down payment, as little as 3.5% down. Or I've even seen people do this with the $1,000 down payment assistance. You can actually buy, for sure, a duplex, and it's possible with the right mortgage guy, maybe even to get a fourplex. You need to occupy that property for 1 year. That's roughly the rules. And hopefully you're renting out the other unit. And I know we told you on this webinar, we were going to tell you, how can you live for free? That's how. The tenant is paying the rent, which covers your house payment, and now you get to live for free. The other strategy we're talking about, and Evan did a combination of both of these, and I really want to educate people. It's called BRRRR, and that would be buy, rehab, rent, refinance, and repeat. So you buy some sort of a distressed piece of property that might need a little work, and then you complete the rehab, which is adding value to the property. Then you rent it out. And so this could work on a single family home too. Then you refinance it, and hopefully, because you added enough value, if you're really planning smart and are a smart investor, you can actually recoup most of your initial investment. Used to be easier. It's a little tighter now. The prices are higher and all that. But what I love about Evan is he combined these two. So I just wanted to make sure you knew what we were talking about. And now we're going to go back and ask some more questions. Okay. So, okay, tell me how you got your first deal, Evan.
Well, the triplex was just an MLS deal. It was about as bread and butter as you can get. But our second deal, kind of like the first more creative deal that we did, was a short sale. So it was a duplex that we purchased in a suburb of Minneapolis called St. Louis Park. And it was a short sale, which means it's basically a pre-foreclosure. The bank has given an indication that they're going to be foreclosing on this property, but there is a period there where you can kind of the person who owns the property can sell it, and then you can kind of like swoop in and make some offers and get a good deal. So we actually used a construction loan, an owner-occupied construction loan by a local bank here in the Twin Cities to put zero money down. So we brought no money to close. We rolled our closing costs into the loan as well, and we purchased it for free, put in about $70,000 to rehab the property. It was in pretty dire shape. It was not great. And then we refinanced out of that construction loan and into permanent financing, permanent fixed 30-year financing at a low rate. I think that one's locked in at like 4.25% or 4.2%. And we lived there again for a year. So that was kind of, how we did that with our second deal. I think we purchased it for $220,000. It's been a while, so I don't remember quite what I appraised for, but basically the way the loan worked was as long as you can, it appraised for, let's say, $400,000. Take 15% of that, that would be 400. So as long as we could get to about $320,000, that's what we could do the entire purchase and rehab of the property with. And that was sufficient money to buy the property. We bought it for $220,000. And then with the extra $100,000 or so, we did the rehab of the property. And then we refinanced out. We took out about $10,000, $15,000 at the same time. And then lived there for a year, again, for free because the tenants on the other side were paying for the mortgage.
Which is great. And really you got that construction loan from a bank, right?
Yep.
It wasn't hard money.
No, it was not hard money.
A
it's the
local
same
bank.
idea as a hard money lender would do, but it's at much better terms. Instead of
Right.
being at an 8, 10, 15, 18% interest rate, it was at like a 7, 6% interest rate. So I mean, it was still higher than what you normally see, but it was a construction loan that was interest only payments.
Okay, we have a question here from Dean. I'm not quite sure if you're loaning as an owner occupied. Okay, you got your loan based on once you leave the property. Is there anything special you had to do with the financing? Once you moved, it was in place. As
Yep.
long there is that 1 year rule, though, isn't there? Is it unspoken or is it in the
Yeah, no, there is a owner occupancy requirement that's usually baked into the loan documents. That being said, um, everything's based on intention. So never should you go into it with the intention of defrauding the government and not living there for the requisite year, because a lot of these are going to be Fannie and Freddie backed loans. But I mean, if something happens, I mean, so say you owner occupy a property and it's a 1 bedroom and you have a kid, well, that's okay. I mean, you can move on and there's not going to, that's a mitigating circumstance. So yes, it's a
yeah.
1 year owner occupancy requirement, but there are mitigating circumstances and reasonable exceptions that you can take to get out of it if you want to.
Exactly. Maybe you got a job somewhere else, that kind of thing. Then you could, without breaking any rules, be okay.
But the financing, yeah, once you've got it as an owner occupied, it's in place, and that's the great thing about it because unlike a commercial loan, which is usually locked or a 5 to 7 year term, this is fixed 30-year financing. So lowest rates available, longest amortization available, 30 years. So you're going to get the best cash flow possible.
Probably if we look at the other side of that, we might be looking at you have to be willing to move a lot.
Totally.
It's
My wife and I moved 5 times in the last 5 years.
Right. Every year you moved. Yeah.
Yep. We saved. So basically, we live on my wife's income, on her W-2 income from the school. Any money I had made from wedding photography, any money we made from the properties, we saved for the next down payment.
Yep.
And then we jump next year.
Yep. And so that's the one part. If you already have a family and you're established in a single family home, a lot of times this strategy might not work because you don't want to move. But what a great strategy if you have a young kid who's 18 or 19 and you could help them with that. This is the definitely the least amount of money out of your pocket way to get started, isn't it?
Yeah, totally. And you can do it with kids. I mean, my wife and I just had a child. We're going to be here for a little while longer, but I mean, we're still planning on moving and doing this. I mean, in the end, you have to be willing to sacrifice a short-term lifestyle in order to get to a longer-term lifestyle. So my wife and I, if we're lucky enough and knock on wood that we are, we're going to retire by the time we're 40. If we're able to keep this owner-occupied strategy up. And that's okay. So we're willing to sacrifice right now, continue to owner-occupy and jump every couple of years in order to continue to acquire properties.
See, and what a great, by 40, Evan, like that's pretty dang amazing. I don't know very many people who can say, hey, I can retire by 40, but it's a plan that you're executing in order.
Yep. There's definitely, it's like, the PEMDAS, the old math, like order of operations, you do certain things in a certain way and you can get great results. And again, like, we're not traveling as much nowadays. We're not doing as many things. We don't do as many extravagant things, and we live relatively frugally. But again, I mean, my goal is that, when my child is in high school, that I can go to every single soccer game, and it doesn't matter. I can go to chaperone trips and stuff or do whatever. So that's what we're willing to do.
Yeah, you're building that passive income so you can live the life of your dreams. That's how I always say it. And you're working hard in a way of sacrificing, by that moving a lot and that kind of thing. Now, some people don't think that's so hard when you're able to live free. There's, being frugal. If you look, a lot of millionaires are frugal underneath it all. They're not.
The average millionaire drives like a 7-year-old car.
Okay, now we got another question from Justin. Do you hire property managers after you move?
So that's a really great question, Justin. I'm a big believer personally in managing your own properties, at least for a while. So up until now, we have not hired property managers because I think it's really important. that you know exactly what a property manager does, because you can't hire a property manager. You can't hire someone if you don't know what they do, especially if they're taking care of such an important asset. Like, so we have done all of our own property management for the past 5 years and learned a lot. That being said, now that I have a 7-month-old, we're definitely at the point right now where we are beginning to farm things out to property managers. And the goal there is, again, to get more time back. We'll have a little less money, but long term, that will allow me to do the things I enjoy more, which is deal finding, raising money, and then spending time with my family.
Just so you folks know, I self-managed a portfolio of 100 units inner city. And the way that I did that is I had a system and stuck to the system, an accountability system for the tenants. And that's the critical thing. Actually, I did it, set up the system, and then I hired someone and she managed, she was an employee.
Yep. And we're definitely going that route also. We're going to hire someone to be the property manager. She's actually one of our tenants, and we're going to be, she's also a property manager, so she has experience, and we'll be bringing her on our team, so we're not having to pay more out.
Great idea. And as you grow, that's a good way to do it. And I know I see Dean's on here, and we had Dean and Renee on a webinar, and, Renee, his wife, she does the property management. A lot of times if there's 2 people involved and that's the income from the rentals, then you split the duties by what you're the best at. So I'm going to ask you this. What was your biggest mistake as you were getting this all going?
Yeah, for sure. I think the biggest mistake a lot of people do or the biggest mistake people do is that they aren't honest about the numbers that they're working in. And that's the biggest mistake that I have had in the past as well. So, you can make your numbers look a lot better by not taking into account how much you should be putting away for repairs or CapEx or other things like that. Your numbers can look a lot better by not accounting for that 15, 20%, or however much you think is necessary. So, I would say that as I've gotten more sophisticated, in the beginning when I was running numbers, it'd be like, oh, wow, look at all this great cash flow that, we can have. But it wasn't quite as good as initially anticipated, just because things do break, and, you do have to spend money, and that's just the reality of the matter. So one of the good things is if you do this BRRRR method and you kind of rehab them, a lot of the properties that we've done a lot of large amounts of rehab to, the CapEx, the repair costs are very low because we've replaced everything. So, that's one benefit that we found that counteracts that downside that I initially had. Now we're much more conservative in how we run numbers.
And when you say CapEx, explain that.
Yeah, those would be, so your repairs are your kind of everyday things that just happen. There is a plumbing blockage that you got to bring out Roto-Rooter for to come out and just snake it out. Leaky faucets, laundry machine is broken and you need to hire someone to come in and check it out. So those are repairs. Your CapEx are your kind of really big ticket items. So it's looking at your roof, furnaces, windows, anything that kind of costs above like a certain dollar amount, like a larger dollar amount. Those would be considered capital expenses, and you should be socking away money in like a safety deposit box or an account where you are able to account for those eventual, because they will happen at some point. You're going to need to replace your roof, and maybe 15 to 20 years away. You can have a depreciation schedule that kind of estimates when that'll be, but you just need to be saving money for that, and that's what CapEx is.
Yeah, that's part of your frugal attitude is how I see it, Evan. You're not just like, oh, this is all money gravy in the bank. No. You're like, we're going to have to do a roof in 5 years, 10 years. Although when you do the size of rehabs you're doing, you handled a lot of that. So it really helps, doesn't it?
Correct.
Yeah. So that's longer term and down the road. So that means you have to save less for that expenditure.
Yep. And realistically, it also depends on how long you're going to be holding it. If you're buying and holding and you're going to be holding it for the rest of your life, then you definitely have to be saving money for CapEx. If this is going to be a 2, 3, 4, 5 year hold, well, maybe you don't have to save for the roof. I'm not saying that you shouldn't. it's a good idea just to have it just in case. And then you have extra money if you do sell and you don't need it. But, it also depends on your strategy. Are you fixing and flipping? Are you holding for 3 to 5 years? Are you holding forever?
And, that's good for any smart investor. You need to have a little kitty there in the background because you don't know, something big could happen and you need to be able to take care of it.
For sure.
You can't lose your tenants over a flood in the basement. You have to be able to handle it.
Yep.
Yeah. So I'm curious about, we got a couple questions. Paul wants to know, where are you finding the short sale properties?
Yeah, so the short sale we found was actually listed on the MLS. It had been sitting on the MLS for about a year and a half. And I think one of the best strategies, there's plenty of deals to be had on the MLS. You can still find them. But instead of approaching properties that are brand new and competing with everyone else, search for the properties that have been sitting for 60, 90, 100 days. Search for properties that are expired or canceled and comb back through the MLS results. So this property had been sitting there for a while and no one really wanted it because it was a ton of work. And in addition, short sales, they're not fun. You have to negotiate with banks and banks are notoriously slow. It took us 4 to 6 months, I don't remember exactly, to hear back that they had accepted our offer.
Yeah.
So, short sales are for the patient, for sure. And you can find them again, MLS. Your county tax assessor would be a good resource also, because they'll know who's kind of missed their tax payments, and you can usually ask for that information or pay for it. So that's an option as well.
One of my favorites, and this is a secret, my nephew happens to be a mailman in the right neighborhood. And guess what? He knows everybody, and he knows when he's delivering foreclosure notices, et cetera, et cetera. He's a great resource.
Yeah, make friends with your FedEx guy. Make friends with your lawn care company. Hey, do you see any properties that aren't getting mowed? Hey, what a great resource. The property 3 blocks over hasn't mowed and their grass is a foot high. Well, that's a great property.
Something's going on. Exactly. Something's going on.
Yeah.
Okay, we have one more question from Justin, and I'm curious about this too. Do you believe having a good tax accountant is important? Do you have one?
I do not, actually. So I do believe that a good accountant is important. But on the flip side, I also believe that, again, doing things yourself for a while will help you understand things better. So, we're getting to the point now where I do really think we need an accountant, especially as we're looking into taking kind of accelerated depreciation and other things on bigger properties. That's important. But up to now, we've done our own taxes via TurboTax. And it's been a good learning experience. I've learned that it's a delicate balance that an investor wants to walk. Our goal is always to take as many deductions as possible by being self-employed. But on the flip side, taking too many deductions means you're not showing enough income to maybe refinance a property. So that's something that I've learned by going through things myself. So, I think it's good to do it for a while, especially when you're first getting started on your own. Really delve into it, learn about it, and then, give it to someone else, for sure.
I would agree with your philosophy, definitely, because if you don't understand the numbers, you're at a big disadvantage in this real estate biz. This is like Monopoly. This is a numbers and strategy game that has to be in sequence, right?
Mm-hmm.
Yeah. So you will need a good tax accountant, but you got to know how to read and have the right questions anyway to get a good one.
Totally. I agree.
Yeah. Okay. Hi Wing is here. He says, has anyone tried these strategies in New York or California? And why he asked that, I'm sure, is because, as we all know, real estate is way expensive in New York or in California compared to the Midwest here. I'm going to answer a little bit, Wing, because I happen to know you, and you yourself have owner-occupied a duplex in New York, in Long Island, and I know it's working better than if you bought a single-family house, but it's not the same as cash flowing and living free. I'm sure of that. What do you think about it working where the real estate's expensive?
Sorry, was that for me or for Wayne?
Yeah, for you.
So, I mean, I think it's definitely still possible. If when you're owner occupying right now, you're still reducing your structural costs and you're saving money. I mean, like, will it be as good a deal as, doing it with a $30,000 duplex in St. Louis, Missouri? No, definitively not. But you're still saving money and you're still able to make it work. So I think these strategies are usable in any part of the country, but maybe you're not going to be getting as great a returns. I mean, that's why you see a lot of people in California investing in other states, but there's still plenty of people being successful investing in California. They're just doing the groundwork. I mean, this is something I believe to be true. The path of least resistance is often the path to mediocrity. So, I mean, if you're not willing to get out there, and here, I've got a list. I've got a list right here. It's many pages long of every single commercial building owner in St. Louis Park. And I have their addresses, I have their contact info, and I'm going to be calling and mailing every single one of these people multiple times. This is how you can find the deals. If you're just hoping to find it on the MLS, well, yeah, no, you're not going to find any deals in California or New York. But if you're willing to do something like this, like here, I mean, these are all the information for the city of St. Louis Park, all their contact info. I'm going to be reaching out to every single one of these owners and trying to convince them to sell to me. So, I mean, you can make it work anywhere. Are you willing to put in the legwork?
Yep. I just sold a single family house in St. Louis Park that happened to be on a lot that's in the commercial zoning.
Mm-hmm.
And I got a lot of money for that house.
Oh, totally.
And the guy, it was my nephew's house, and he owned it since 2011. He just changed his life with that deal that he bought on a foreclosure.
Yeah.
Yep.
Yeah, totally.
It's, but it's about buying the right thing in the right market and then maybe holding for a certain amount of time, because we knew that was going to come eventually, and it did. And it didn't take that long.
Part of it's luck, for sure. Part of it's luck, and like, are you buying in the down or up market?
And this strategy works. The big thing about this is less down payment out of your pocket if you're going to live into it. That's huge, because I can't remember when you presented last time, Evan. I remember you had a slide, and I loved it, about like how much it would have taken you to buy those properties had you have paid 25% down. Like you would have needed $300,000 or something, and how much it actually took you out of your pocket because you were doing 3.5% down or whatever.
Yeah, so I mean, we over the course of the years would have spent like $250,000 or $300,000 purchasing each property with a traditional 25% down commercial loan. Instead, I think we spent something like $70,000. It's a little more nowadays. We just bought the place we're living in right now, so it's probably more like $100,000 and like $350,000. But I mean, yeah, I mean, it's an order of magnitude in terms of savings.
Oh, huge! And so, again, if you're growing a portfolio in California or New York, that right there is a huge difference.
Can I comment on questions? Is that okay?
What now?
Danny Vang had a question here that I think kind of ties into this really well.
Okay, sure. Comment on that. What do you target for cash flow per unit and cash on cash return?
So the great and disingenuous thing about this strategy is your cash on cash returns for this strategy are going to be through the roof. Because if you're only putting 3, 5, 0, 15% down on a deal, your cash on cash returns are going to be hitting 60, 70, 100. If it's a 0% down loan, an infinite amount of return. So, I mean, what do I target if it's with this sort of deal? I'm usually looking for 50, 60, 70 plus cash on cash returns. If it's a conventional deal, I am looking to beat what I can make in the stock market. So I'm a decently active trader. I dabble with options and other things. So I can pretty consistently do about a 9.5% to 10% return over the years. So I would be looking for a higher return than that, because that's my opportunity cost. If I can get a 12 or 13% cash on cash return, then that's much better than I'd be getting in the stock market. And then in terms of cash flow per unit, I think a general number just as a barometer is kind of be making $300 to $500 per unit.
Yeah. A month.
A month. Yeah, a month. Sorry, a month.
Yeah. And that I like, that's a realistic number, 300 to 500, right in there. That's what you see out there in the market.
And you can do better, but I mean, that's like the minimums. Like, will I bother looking at something, each unit's getting $150 per month? It's not worth my time.
Yep. Okay, we got Justin. Has anybody tried BRRRR in rural areas that have increasing populations and decent job markets? I would say my answer to that is it can be okay. Depends on how far that rural area is away from the jobs. Like if you go to small town Minnesota and it's an hour and a half to 2 hours to the jobs, it's not as easy to make it work. Yes, your building is cheaper, but your rent is cheaper.
Can I comment on that?
Yes.
So in Minnesota, there's something called the Iron Range. It is northern Minnesota. It is where the vast majority back in the day, like Pennsylvania, West Virginia, of the iron in the United States was mined. It's still mined there. U.S. Steel has some operations up there. And there's a little town up there called Eveleth, Minnesota, where I almost bought a 90-unit apartment building. The 90-unit apartment building would have been, I think, $600,000. I opted not to do it because of exactly what you mentioned. The jobs, it was a single employer market, which would be mining, maybe a little bit of logging up there. Could I have made it work? Yeah, totally. I mean, like the numbers look pretty good on paper, but I mean, you deal with high vacancy in rural areas. So it's a little bit different than your question, Justin. I think it's totally possible. I think what you're looking for is you need to have multiple good employers in the market. If you're having one or two good employers and one of them closes down, well, there went a quarter of your renter population, and now you're no longer breaking even, and you're actually having to pay money to subsidize it. So I'd be really sure about your job market. I think that's a really important thing. And yeah, I look at the population and census data. What's the year-over-year trend? I would not look for anything that is stable or even slightly decreasing. It has to be increasing at, 10% amount. I mean, choose your number, but there has to be that increase. So can it work? Totally. But you've got to be really sure of your market.
And, one time I bought some property in Birmingham, Alabama, and the reasoning behind it fits into this sort of rural edge of town thing. The thing of why I bought there was because a military base was being, or no, that one wasn't that one. This one was a Hyundai factory was being put in and creating 8,000 jobs. And it already had a good job base. Now we had that. So with those demographics, I knew that buying some rental property around there also was a military base, would just really work. So it was, again, combining some market conditions. So if one fell apart, the other one was there.
Yeah, cover your bases.
Yep. So that's really interesting. I like your Eveleth story because, like you say, it looked good on paper, but you had to think it through.
I tried really hard. If I could have gotten it for like $200,000, I would have done it. But it needed probably about $800,000 worth of work to put into it.
Okay, it needed a lot.
So it would have been a BRRRR in a rural area. But yeah, I mean, it was a really bad condition, probably a C- D condition property. So
yeah, and that's a bigger gamble when it's in that bad condition. If it was in the right location, though, the payday is bigger too, but not in the wrong location.
Yep.
Okay, let's see. Giovanni wants to know, that list you just had, how did you get that information? Is it public information?
All this information is public. You can go to your city hall and the rental licensing division or whomever. You'll have to do a little bit of searching to see what exact place it is, but all this information is public information. You can ask your city rental desk, can I get a list of every single rental license in the city of Minneapolis, in the city of Milwaukee, Wisconsin, in Los Angeles, wherever it is, and they'll give it to you. Maybe you have to pay depending on the municipality, but yeah, you can get all that information. It's all out there, and most of it's free. Just go ask. So go to your city hall, ask where to get these large information batches. Sometimes it's a special division that will have to give it to you, but it's all available out there, and you don't have to pay for a list. You don't have to go to ListSource. You don't have to go to whomever. But this is the start. From here, you can kind of like develop your own list, and then if you need to skip trace them or get additional contact info, you can do so. But this is where it starts, and you can get that from your city hall.
Well, and what's really important here is you can get the list, but this is where I see investors fail. You got the list, but you don't have a system of what you're going to do and how you're going to contact the people, and it's not a one phone call ordeal. Mm-hmm. This we're talking sales here, guys. We're talking, you might have to call them 10 times, and you probably need an email campaign to follow up. And it's really about building the system so that it's not hard work. It's a systematic thing, and that's how you're going to get your great deal.
Yeah, and it won't be easy. Again, the path to mediocrity is the path of least resistance is the path to mediocrity. I mean, like, if you're not willing to put in the work, you're not going to find the deals.
That's right.
If you're just expecting the deal to fall off the MLS and appear, it's not going to happen. It's just not a thing.
There is deals on the MLS, though.
Yeah,
they're there, but to get the real screaming deal, like that developer who bought my nephew's property, I mean, we got him up a lot in the price because he's going to build an apartment building there. Mm-hmm. And it was obviously not what you could have got if you would have put the single family house on the market. It was way more than that. But it's what's the highest and best use of that piece of land is the game here in real estate. So Martin's asking us, do you base your returns on cash flow or net operating income, NOI?
I've done both. When I was beginning, it was more so based off of cash flow and, kind of what the cash flow is. But nowadays, everything is based off of NOI. NOI gets you to cap rate. Cap rate gets you to comparative. It is your apples to apples comparison. So nowadays, I think it's important that starting out cash flow is just fine. If you're just looking at duplex, you don't need to worry about your NOI. But once you start getting into 5, 10, 15, 20 unit buildings, it's all based off of net operating income. You are buying a business, and a bank will loan based on how that business is performing. And the comparative analysis there is net operating income. So, yeah. And
expenses differ a lot on that 90 unit apartment building than they do on the duplex, fourplex ordeal. But even on those, looking at the NOI, that's really boiling down to having cash flow.
Yep, correct.
So, but you know what you can tell just from what we're talking about here, you need to know your formulas and you need to know how to compare apples to apples. Otherwise, that's where you make your mistakes. I see a lot of people make mistakes on the expenses. You can't always believe the numbers you're being given, on some listing. You need to know enough, maybe from owning some already, that whoa, that insurance number's way off. Or, get your own quote, or you start to get a feel. That's why I like to start in the duplex, fourplex, because then you get a feel of it and now you can multiply on those numbers. But you have to understand this or you won't catch where someone has been way off.
And again, kind of building on that, build your own spreadsheet. Take the time to learn Excel. Don't just use the Bigger Pockets calculator. Don't just use the Guru spreadsheet. Build your own spreadsheet. I have an intrinsic understanding of the numbers that I can just kind of generally know the cash flow. I can know the debt service. I can know the expenses. And I can just do it in my head now. I don't even need, for just like a first blush look, like I don't even need my calculator. I can just take a look and I know, yes, this will cash flow enough for me to delve into it more. Or no, it's not even close. I'm going to waste my time. So build your own spreadsheet.
You got to get good at that, because I can do that. I can find a good deal on the MLS like that, because I know how to find that needle in the haystack. I know what I'm looking for, and I can tell just looking. It's pretty easy, but it's a honed skill that takes practice. So let's see. Jackie, she wants to know if you have any systems that you'd recommend for that marketing. You know, that marketing, you found the list. Do you have some built-in systems?
Yeah, so I use a website called Pipedrive that I export all of my contact info into, and it's basically a CRM platform that, you know, gives me the touches and helps me follow up and know, like, okay, I've called the person on Tuesday, I left a message, I need to call them back in 1 week, and then I need to email them, and et cetera, et cetera. So Pipedrive is the system I use. Are there better ones out there? I'm sure there are, but I mean, Pipedrive, mailers, I don't personally, I hate wholesaling. I mean, I'm kind of getting into that a little bit, not necessarily wholesaling, but, you know, kind of doing the legwork there. But I dislike mailers, other stuff. So I'm more so trying to call people, email, touch base with them like that. But I'm sure there'll be some mailers sent out as well for the deals that I think are especially compelling.
And I would agree with you. You know, us as realtors, you know, we all have a CRM. That's a relationship management software. And exactly, because we can't remember all this in our head. If you're doing marketing, you better have a system. And there is a ton of them out there, and Pipedrive works just fine. And it's not expensive either, is it?
No, it's I think I paid like $120 for the whole year.
Yeah. Because, you know, anybody who's operating a really profitable business, they're not using sticky notes, you know, because you're not going to remember to call the people at the right time, and you'll get people, you know, like us in real estate, that's how deals slip through our fingers.
Yep.
So, and it's the same thing. I like what you're saying here, Evan, because you're running a business. That's what this is.
You need to systematize everything. I mean, you know, without having systems in place, everything falls apart.
Okay, now Justin has a question here. Are either of you two open to face-to-face networking mentorship? And actually, I am going to put up, I do coach and train investors all over the United States. So I'm just going to show you here. I have an offer. It showed up right there. And I have a free training, and you can sign up now by pushing that button. Can you see that on the side? Nope, publish. I have to there. Now you can see it. Do you see it? Yeah. And what I have, it's about a 45-minute webinar where I actually talk about these real estate strategies, and I show people who have done them with some numbers. And so you can learn those investment strategies. And then if you're interested in some more coaching, I actually offer a strategy session. So you can start with that webinar right there if anybody's interested.
Yeah. Okay. And then I don't necessarily do coaching or anything like that. If you just want to sit down for a cup of coffee with LeAnn's permission, yeah, I'd love to sit down and just talk shop, but I'm not really, doing like the mentoring aspect of it. I'm more so just come get a beer with me and let's talk shop, because it's fun.
And that's great too. You know, that's what I notice about real estate people. And I've run this networking group for over 10 years. So happy to share and help other people along. I love that. Even though there's maybe 7 or 8 real estate investing groups, probably 10 or 15 now in the Twin Cities, we all show up at the same stuff, and we share and learn and network and do deals together. That's what's cool about this type of investor. There's plenty of deals to go around for all of us, right?
Oh, totally.
Okay. Now I want to ask, what website do you use to find phone numbers? Oh, there's a ton you can subscribe to. Like I subscribe to Intellius. There's a lot. Do you subscribe to one of those?
So I do, there's LexisNexis, that you can do. And basically, yeah, what you're talking about right now is skip tracing.
Yeah.
And how you find their contact info. That's how. Yeah, you can just find these websites. I think I have one up here right now. Let's see here. The other one I use is Bell's Link. That's an option as well. So there's a ton of websites out there, and yeah, not everything will be perfect, but I mean, like, it is definitely there and available.
Yeah, and you got to dig through. It's like being a detective sometimes to get to the bottom of it, right?
Yep, definitely. I mean, it is. You have to put in the legwork again to find this contact info. I mean, sometimes it's easy enough just to go onto Facebook and just see like, oh, here's their business and here's their phone number. Sometimes it's not listed and you got to delve into it.
So what advice would you give somebody just starting out?
Be willing to change your lifestyle. Who, pardon my French, gives a crap if you live in the white picket fenced house with the beautiful shutters and it's overlooking the creek? It doesn't matter. Like, if you're serious about this, be willing to sacrifice a little bit and go for it. I mean, like, it's possible. I mean, you'll be scared when you do your first deal, but you just got to go for it. Like, jump in, buy something. You'll screw up. I've screwed up. I've had crappy tenants. I've had pipes burst. I've had it all happen. But you know what? It's all surmountable if you have the positive attitude and you go for it. And you just got to jump sometimes.
What do you do around that the mindset? Do you have any, things that you practice to? I'm sure you've been in sticky deals and the rehab's not going okay and, all that stuff. What do you do?
Yeah, so I mean, for me, I generally try to remember my why. My why being my family and making sure that they're the reason I do all this. I want to make sure that they have the lifestyle that they deserve. And this is how I do it. So, I mean, if something bad happens, that's just fine. Who cares? I mean, like, I've literally had a flood in one of my duplexes. That's happened before. Water coming in and, like, man, going downstairs and finding 3 inches of water is the worst thing. But you know what? It's worth it. We got through it just fine. We changed all the grading. We fixed everything. It was a bad couple of hours, but then, we made it work. So it's my why. My why makes everything worth it, and that's how I keep a positive attitude.
Yeah, that's great, because that's a big part of this. People can get scared, particularly brand new investors, that getting that first deal is, you really have to cross over the red line to just put that money down, all that money and all that faith, and do it. And once you've done that, once you did the hard rehab, once you went through the flood, it's just like, okay, another flood. I got this.
Yeah, totally. And our latest rehab, I mean, it was a $150,000 rehab. It was twice as big as our $70,000 rehab. Way more scary. Not insurmountable. Not insurmountable by any means.
Yep. I had a building. It was $1 million building, and there was a $700,000 fire. And I got a desperate phone call. Your building's on fire. And I remember throwing the kids in the car and driving over there and just watching it burn, and thinking, oh my gosh, how am I going to handle this? It was a commercial building. And, I lived, right?
Yep, totally. I mean, and that's why you have insurance and things, right? I mean, like.
Right. Better have good insurance. And you know what? I was grateful that I had a good insurance agent, because what I had was I had on there 6 months of where it covered the rent. Like, I got paid while it was getting fixed up. Thank God I had that on there, because it was like $10,000 a month rent.
Oh yeah.
So that was huge. And thank goodness I listened to my insurance person who recommended you have loss of rent on there.
Totally. 100% agree.
Yep. So sometimes I'll ask you that about insurance. It's really important to cover the back door here, I guess I would say, as far as the insurance, your liability, your umbrella, all that. You better have your assets protected.
Yeah, I agree. We just started a new venture where one of our duplexes actually has a home health care company in there for elderly folks with dementia. and that is risky. They could get hurt, they could trip, they could do a lot of stuff. But we have really good insurance. We also have a good lawyer who advised us on how to make sure that we're covered and whatnot. So I mean, yeah, having a good lawyer, having a good insurance agent, they all help they all help make up part of your team.
Absolutely. So who do you consider your mentors or coaches, like, as you're growing this?
Mm-hmm. I have someone who I look up to a lot in the industry. His name is Todd Dexheimer. But he's kind of going towards that's big apartments. And, it's the people who are doing big things. That's what I want to do. So, I mean, those are the mentors, the people who are doing the really big, awesome, exciting things. And realistically, you can learn from everyone. I mean, even before we started, I learned something new. We were talking, and what was it? A whole tail. So I mean, I learned something new just before this. So, I mean, you can learn from anyone. I mean, you can, as long as you have an open mind.
That is so true. Okay, and did you go faster because of all your educational and learning and paying attention to what everybody was doing?
I've never really been one to go slow on things. Sometimes it gets me in trouble. But I mean, it's why I started a business my freshman year of college, to help pay for college. I mean, you just got to do it. You just got to go for it. So, I mean, I like the idea behind going fast. I would say if I could have started earlier and gone faster, I would definitely do that. The time value of money is exponentially better the younger you start. It's never too late to start, but I would love to have started when I was 18. That would have been great. I started when I was 24, 25, and that was great as well. But it's when's the best time to plant a tree? 40 years ago. The second best time to plant a tree is today. So, I mean, you just got to do it.
Okay, we got Dean with one more question. What legal structure do you set up for? Are you under an LLC, or what are each property?
Yep. So doing the owner occupied, you're not going to be able to put things into an LLC initially.
Right.
It's going to have to be in your personal name, and then later on you can transfer them into LLCs. So I have one LLC for all my properties. I think it's a little overkill to have one LLC per property. I mean, that's really complicated for no real benefit or reason. I mean, maybe you have a little more insulation, but I would say it's marginal at best. So, I mean, we have all our properties under one LLC. And then as we continue to grow, we'll add on additional LLCs, and there'll be a holding company above that, which will hold each individual LLC, which will hold 3 to 5 properties each.
Yeah, so you have a structure in mind, but you're right. When you own or occupy, that's personal loan. Mm-hmm. It just is. Yeah, and handle that.
Again, part of the reasons you have the LLC is that liability protection. So get an umbrella policy above your regular insurance, and it will do the same thing to a certain extent.
Yes. Okay, I got one more thing I want to tell everybody who's here. And this is another place to network. And so I have a Facebook group that's called LeAnn Riley's Real Estate Investing Club. And you can join that for free. And that's where you can put these kind of questions and other people might answer you. So I'm putting that up over on the side. Did it show up?
Yep.
And you can push that link there, and that'll shoot you over to whatever, and you can join. And I post a lot of information on there of what's going on in different markets. Or what did I put up today? Oh, you know what? I put up something today about these service animals versus emotional animals. There's 3 kinds of animals people are getting around the pet policy with, and as a landlord you need to know about that. So I posted an article that it really explained what that all meant. So go ahead and join that group if you want. That'd be great. And then I'm going to end with the last question for you, Evan. What's your goals for 2020?
My big goal here is to scale up You said you kind of alluding to in the previous question, go fast, go slow. It's time to really start scaling up. So we are working to start purchasing some 20, 30, 40, 50 unit apartment buildings here in the near future, and also start working a syndication. And a syndication is basically a way for a lot of people to work together to take down a larger deal. So we'll be trying to run our first syndication this winter, and via that purchasing a cool investment property somewhere. We haven't identified it quite yet, but we were looking at a 23 unit apartment building just the other day over here in Minneapolis that was off market. So always looking.
Always looking. See, I can tell, like you said, you're going fast. You're finding mentors who are doing what your next move is. They always say, you are the 5 people you hang with, and it's really important to be hanging with people who are doing your next strategy. That's how you're going to figure it out.
Yeah, and you don't want to be the biggest. You don't want to be a big fish in a small pond. You always want to be like the smallest fish in a bigger pond with bigger fish. You always want to be learning. So I do want to be surrounding myself and talking to the big syndicators, Minnesota, the other people who I aspire to be some days. Those are the people I'm trying to learn from right now and work with. So that's where we're going.
Great. And I can tell, Evan, you've got the drive and you're not afraid to call the people or do the things. You've got the entrepreneurial spirit. You've had it since you started your photography business. You have it. And that really works well with real estate investors. So thank you so much for taking the time to visit with us today. Yeah. I've learned a lot from you. We've covered a lot. And thank you, all you people who've been on here. Great questions. Yeah. Lots of new ideas. No matter where you're from, this is what works. Look at how fast he did it. So really excited, and we'll be talking with somebody who's doing some condo syndication at our next meeting in December 11th.
Cool.
The 11th. There you go. So good luck to you, Evan, and to your new baby and your wife, and growing your portfolio. And I'll be talking with you soon.
Sounds good. Hey, thanks so much for the opportunity. And like I said earlier, if someone wants to just grab a beer and have an informal conversation, let me know. If someone's looking for like a more in-depth thing, LeAnn's the gal. So I really appreciate your time and the opportunity to speak here.
Did you see in the questions, there is a guy who wants to have beer or coffee. Did you see it over there,
yeah,
Justin?
Grab his email and I will email him.
Okay, perfect. Good. Great. Thanks so much, everyone. See you next time.
Bye.
Bye.